Welcome everyone and good morning. Before we get started, I want to quickly set the stage a bit so you all have some context for what we're doing here. Firstly, my name is Peter. I'm a senior associate here at 500, and my job is largely to work with a number of corporate investors and innovators on projects related to startup investment, startup partnerships. But this event in particular is being hosted as a part of our ongoing Slack community called 500 VC. 500 VC is an invite-only Slack community for corporate and institutional investors to engage in helpful conversation, networking, and ultimately empower founders. And so we host networking events, startup presentations, and discussion series like this one. And so within the Slack group, we started the Corporate Venturing channel to be a collaborative community through which members can share best practices and learnings, as well as help enhance the perception of CVC among the broader startup ecosystem. And so if you're at all interested in joining a community like this and you aren't already a part of it, please feel free to shoot Sean or myself an email. I'm going to go ahead and drop our emails in the chat below in a second. But for this event specifically, it is a bi-weekly speaker series featuring top corporate venturing practitioners like Jason, sharing their unique stories of CVC, specific challenges, and best practices they've developed as a result. So I'm going to leave it to our host, Nicolas, to introduce our guest for today in a second. But first, a couple quick housekeeping things. First, we're going to launch a couple of polls throughout the session just so we can better understand who's in the audience and make sure that we're sharing relevant thoughts. And then second, we're going to have Q&A on. So as we're talking, if you have any questions, just feel free to throw those in there and then we'll try to get to it when we can. All right, so now that you know what's going on and who we are, I'm going to go ahead and hand it over to Nicolas to kick things off.
Thank you, Pete. It was really good for 500 startups to have this initiative. And really the purpose is to learn about all the different ways of doing corporate venture. And I'm so glad to have Jason in our first bi-weekly. He's a managing director of VFS Innovation Ventures. And he's going to have the next 15 minutes to really present his journey in this corporate venturing and how he started it and how he's executing it. But then I will, after that, ask him a lot of questions about what's special about what he's done. So Jason, all yours.
Yeah, great. Thanks for having me, Nicolas, and to the 500 team for inviting me. I really think that this is a great initiative, and you know, there's quite a big or a lot of momentum behind corporate venturing as a whole, and I think that, you know, sessions like these will continue that momentum. You know, I put together just a few super high level slides, but, you know, looking forward to, you know, kind of making this a little bit informal and hopefully introducing some topics. And, you know, Nicolas, I'll allow you to kind of guide us, you know, through the conversation. But just as a little bit of background on myself, again, Jason Miles. I have about 20 years of experience in, you know, everything from capital markets transactions to private equity and venture capital. You know, I started my career in the late 90s before the .com bubble as an investment banker with Robertson Stephens, which was one of the quote unquote four horsemen of San Francisco, you know, again, during the .com craze, you know, where I was responsible for raising venture capital for new startups, particularly at the growth stage, you know, of development. You know, did deals for companies like wine.com, which I'm sure a lot of us use still, stamps.com, which I'm sure folks see a lot of commercials for still, and others. From Robbie Stephens, I moved over to Bank of America Securities, where I focused on continuing to raise capital for private companies, but more so on the late stage and traditional private equity stages. After B of A, I moved over to another boutique investment bank called Viant Group, where we did early stage M&A transactions. We actually did one of the first team acqui-hires in the industry, where we sold companies to large players like Yahoo and Google. We sold a company called Urchin to Google, which became Google Analytics. Suffice it to say, early in my career, I was, highly focused on transactions. With that background, I wanted a little bit more exposure to how transactions affect corporate strategy. And I moved over to Bank of America's corporate arm, and focused on doing corporate development transactions, large joint ventures, small acquisitions, especially in the financial services and mortgage sector. The biggest transaction and probably most famous that I was a part of was the Countrywide transaction during the financial crisis, which really gave me a lot of insight into, again, how corporate strategy drives M&A activity, and what some of those, the market, how the market environment really drives that decision making. After B of A, I went and got my MBA at Wharton, and continued to kind of round out some of the more financial and technical aspects of my career. After Wharton, I really wanted to kind of get a little bit more exposure into the final leg of financial services, which was investment management, and really seeing, how the pension and endowment market worked to influence financing decisions. Because ultimately, an asset is passed over the life of a company or the life of the asset from the founder or creator through all the way to, Main Street. So it passes from Wall Street to Main Street. And, that was, and vice versa, they kind of work together. But that was a good opportunity for me to see kind of that end-to-end transition, and really try to understand, what do large foundations and endowments and pension plans like CalPERS or the state of New York, what do they look for, and how do they assess money managers as well as, investment opportunities. So I was the head of strategy for a $7 billion fund of funds in San Francisco. And we were really focused on emerging managers. So, folks with less than $2 billion that were really startup investment managers. So it was, again, a good level of exposure to an area of the market that I hadn't seen, and from an investor standpoint, I think it's critical for one to have a view on where your stock ends up at the end of the day, and it really ends up in the 401ks and retirement plans of teachers and firefighters and police officers. So it really gave a good additional view on the market. After that, I really wanted to focus more on the creation side of the market. And, I founded a small Fintech startup called Crave It. Very small. Most of you not heard of it and won't hear of it, but it was focused on crowdfunding and blockchain, and how those new technologies could be applied to e-commerce, and how it could, quote unquote, democratize the purchases of retail items. So, at that point, it had given me a very good view on, product creation and how to enter into a competitive market with a product, and also develop it from scratch. Obviously, I'm a banker by trade, so I'm not an engineer. And, it was a good experience with, product development from a pure engineering and technology standpoint, and really kind of understanding how these things interact, and how the various parts of the puzzle come together to create something for the market. A couple of years ago, I joined Volvo Group, Volvo Financial Services in particular, to lead their corporate venturing effort around innovation in the fintech space. It was an interesting change of direction for me, but it was an opportunity to really apply all of those experiences from the previous years create something new within a large corporate. So kind of being an entrepreneur, while also working with small startups that are looking for product market fit. Overall, that's my background. About 20 years of experience, across financial services, technology, and most recently, mobility and logistics. If I really boil it down, my overall motivation throughout my career has been, to really embrace creativity. I can be highly focused, but I have a very interesting attention span. At least that's what my grandmother used to tell me, where, I like to create things and look towards kind of the bigger ideas. So I'm on the big idea side of the spectrum. That kind of led me into, really focusing on applied entrepreneurship and how I could impact entrepreneurs and help them bring their products to market. And as I said before, my current vision and what I do at Volvo really surrounds, how to create or enable an integrated transportation network, where the infrastructure, the vehicles, the drivers and the users of those vehicles all interact to create new business models. So in the future, you can imagine, a long haul trucker with an app inside of his autonomous vehicle. And that app is not only guiding him to where he needs to go, but it's also helping him on a per mile basis with his investment strategy. So over the next 10 years, you're going to see, I think, a big confluence of all of these different factors come together and create new business models. And that's what really excites me today. So with that, that's my background. If anybody wants to, contact me, obviously reach out to me on LinkedIn. I have my little LinkedIn title up there if you have to get in contact. But, with that, I'll hand it back over to Nicolas and, let's get started and maybe move to the next slide.
Okay. I thought you were going to present the next slide and the third slide, and then I would start.
Hey, so, I can do that. Let's move forward and just keep going here, and then we can get to the fun stuff.
Very good.
Okay, good. So let me tell you a little bit about VFS Innovation Ventures. So as I mentioned before, I joined Volvo to help them with their innovation strategy, particularly around how to leverage early stage startups to help push our innovation agenda forward. So when I first joined Volvo, VFS Innovation Ventures didn't exist, and they were doing things that were focused on kind of the prioritization around innovation, meaning, where to focus their effort and attention. Just a little bit more background on Volvo Group. Volvo Group owns Volvo Trucks, it owns Mack Trucks, it owns all commercial vehicles, but it does not own the car company. The car company is now owned by a Chinese private equity firm called Geely. But on the Volvo Group side, we have all of these different brands that produce commercial vehicles. And then we have Volvo Financial Services, which provides the funding and financing to the customers that purchase those vehicles. So as you can imagine, the services that VFS brings to market are things that you would get from a bank, loans, lines of credit, and all sorts of different financing opportunities. But there's also quite a bit of technology behind the delivery of those services, from billing to subscriptions, and all of the things that would support a customer that recently purchased a very large device. And that device in our case is, a commercial vehicle, a truck, a bulldozer, a refuse vehicle, et cetera, et cetera. So we figured out a few areas that we wanted to focus on, and really wanted to figure out how we could accelerate our activity, and really get access to more R&D within that activity. Because Volvo Group has been around for about 100 years. It's one of these huge companies, in over 100 countries, 100,000 employees. So innovation and R&D, while it takes place very regularly on the vehicle side of the world, it does not take place in large OEMs on the service delivery side of the world. So we decided to really focus our efforts on working with startups that could help accelerate our new service development and delivery. At the time, we did not have an efficient vehicle to really deliver those types of services, and to create those services. And the reasoning was kind of theoretical in nature, but it was also very practical. So the way I like to think about what we've created is we address two major challenges, right? So the first challenge is from the startup side, right? Especially for early stage startups, they have extremely high operating leverage, right? Because they have so many intangible assets, the intellectual property, the code that they develop on, and the output or the sweat equity of the founders and the folks working with them. But within that, they have extremely high short-term working capital constraints. So they're constantly raising capital. And, it's because they have to support kind of a persistent negative earning profile. And, all of that is alleviated if they have a great revenue ramp, but they can't get a great revenue ramp until they find product market fit. So they're constantly having this innovators or founders dilemma around raising capital, developing a great product, and it makes it difficult for them to serve very large enterprise clients because of these dynamics. On the opposite side, corporations have their own challenges, right? It's very difficult for a large corporation to embark upon R&D efforts because of the budgeting processes. They're also operating in extremely dynamic business cycles where they have to, report every quarter or every 6 months to their shareholders. They obviously face, huge competitive threats around disruption, especially in sectors such as mine, where it's commercial vehicles and OEMs. And in order to introduce new products, big companies have to, balance the introduction of those new products with the cannibalization of their current business.
This is time, and this is a good segue to move to the third one, where you talk about FOMO.
Yes, exactly. And those are the things that we've tried to, systematically put into our program, where we can kind of help alleviate some of these biases. But that's why we created VFS Innovation Ventures, right? It's a structured program. We provide capital to commercialize new ventures, and help some of these companies along, while also helping VFS innovate around some of our target areas. We focus on late seed companies all the way through late Series A, and companies that are very close to product market fit, or they have product market fit, but they just have not explored the commercial vehicle sector. In order to assess that, we typically look for companies that have traction, with other global 2000 corporations. And obviously, given where we focus in the OEM space, Fintech is a huge one for us, a huge sector for us. ACEs, which stands for Autonomous, Connected, Electric, and Shared Vehicles. And then from a bigger perspective, all of this has to play into like a data orchestration and an analytics model that can help us create that network effect that I was describing before. So, that's kind of a high level view of VFS Innovation Ventures. We typically play again at kind of an early stage, where we're putting, up to $1 million to work with small startups. And, you know, we like to work with folks that already have or could potentially have a relationship with VFS. But that's pretty broadly defined. So if there's a startup that has a product that could be applied to something that we do, then we're willing to work with them. Our first investment was in a company called Rain, which is an insurtech platform. They are a good example because they had product market fit within the drone space and the agriculture sector, but they had not had any exposure to the commercial vehicle sector. But their platform had high applicability to commercial vehicles, and we brought them on board. So that's again a little bit about me and about Volvo Financial Services. So you know, and to Nicolas, to your point, you know, maybe we could talk about some of the biases and FOMO.
Oh, we will. But actually, what I like what you just did, Jason, is of course you talked about you and you talked about Volvo, but you also talked about the company you have innovated in. And I think that's one of the good traits for any corporate VC is to really make sure that we talk about our portfolio company. There is a reason I started with this background, is it's my way of talking about the companies that we have invested in. And so the fact you ended up like this is, I think, a very, very good trait for corporate VC. So well done for this. A message for the audience. We have 500 startups who are going to send a poll question. We are going to have 3 in total, but the first one is going to come up. So if you can be on the watch out, that would be great. Jason, let me start with a conversation we had before. We all know about the innovator's dilemma. I'm wondering if you can talk about your view about the investor's dilemma. And of course, it touched on the biases, but tell us about your way of thinking there.
Yeah, it's you know, it's an interesting thing to kind of think about when you're, especially from a corporate VC's perspective, right? I think the dilemma for any investor is around 2 things, right? The first is which investments to select, right? And that means industry, company, founders, management team, all of those things that we all think about. And the second is when to invest, right? So it's timing and selection. The interplay between timing and selection increases the level of biases that I think investors have whenever they're making a decision, right? You know, for example, I'm sure everyone has been following the market. You know, last year, Tesla was, you know, $200 or $300 per share, you know, and now it's, you know, I don't know what it is today, but about $1,300, $1,400 per share. You know, not much has changed in the thesis behind what Elon Musk is doing, but the investor interest has increased exponentially for a variety of reasons, you know, market-based reasons, financial reasons, et cetera, et cetera. And as an investor, you have to manage your own biases to determine when you're going to get in to a particular investment. Public markets are very easy to get in and get out of. Private markets are extremely difficult to get in and to get out of. So your biases become even more impactful on your decision-making because you're essentially beholden to your investment decisions for a longer period of time, right? So that's really the dilemma. You know, make a selection, get in at the right time, because that's going to give you the outsized return that you're looking for. You know, if you get in too early, that's equivalent to getting in too late, right?
Find the right time.
That's right. That's right. That's right.
Very good. And so maybe, I mean, you are a very new corporate VC. So what it is that you learned in the last year that you feel is helping you to understand better this bias, this investor's dilemma, and all the bias around it? And maybe for everyone who's listening, is there a mistake you made so far that now you will not make again?
Yeah, definitely. So from a CVC perspective, the biases that exist are very stark because people talk about, I mean, your first poll answer, our question was strategic versus financial return, right? Most CVCs have a strong bias, either for financial or for strategic return. The balance of those two, I think, is where the success, that's where the sweet spot really is, but it's very difficult to balance those two, especially if you're investing off of the balance sheet of the firm versus investing in in a green or evergreen fund format. Those biases become more and more apparent. So from our perspective, I think that we've gotten the sweet spot of financial and strategic return right, but the thing that we're struggling with, or that we have struggled with, is the timing, right? How do you move faster to make decisions? Because you might have a great company that meets both of those perspectives, but the process that you put into place has to also meet the timing part. Because again, being too early could be a challenge and being too late could be a challenge. And with startups especially, you might miss the train, because you're trying to get things together and put together a great investment committee pitch and all of the things that are required for traditional corporate decision making, and you might miss the opportunity. And then on the flip side, you might not want to miss the startup, so you make a quick decision that doesn't necessarily meet a good view on financial and strategic returns. So, those are the two real biases that we try to address. And, from a mistake standpoint, we haven't been extremely active, so we haven't made a huge number of critical errors. I mean, in the investments we made so far, we haven't seen the outcome yet. But I will say if we are to adjust or make a quick adjustment on where we are now, I think it's going to be around speed and timing. Because again, that's the other leg to the investor's dilemma.
That was my next question. So I have a very strong bias that corporate VCs need to be able to react fast, both after investment, but also during investment. In June, we made an investment in a company. From the first meeting meeting the CEO to the money transfer was 25 days. So I have a very strong bias. Yeah. But I'm going to challenge myself and challenge you. Do you actually think that for corporate VCs, we need to move fast? Or actually, because we bring so much more than just money, maybe timing is not that important?
That is a great question. And I think that this goes back to kind of my banking background, right? I think that you can structure your way through some of the biases that you have, right? If you want to move very fast, then the structure of the deal that you get into needs to meet that level of speed so that you don't get whipsawed, right? On the other hand, if you want to move slowly, then there's ways that you can insert yourself into the startup's capital structure without slowing the startup down, right? So you could help them with a bridge note, or you can do warrants in between a round, or you can negotiate equity at a future round based on the terms of the current commercial structure, right? So you can balance it out where you don't miss the deal, right? That's a lot of what I've kind of helped design in Volvo Financial Services, is how do you structure a transaction so that you don't get whipsawed, but you also don't have to move so fast that the corporate doesn't feel comfortable, and you don't move so slowly that you miss the opportunity. There's a deal to be done for everyone, right?
Your background in deal making is really important here, because I think a mistake I've seen is people think that if you've missed a round, you've missed the opportunity to get involved. And that's totally not true. If you can bring value, then you will be able to get a deal.
That's right.
So maybe one question, maybe the audience will be as clueless as me. What does whipsaws mean?
Whipsaw. Whipsaw means, so they say buy low, sell high. A whipsaw is when you bought high and you have to sell low.
Oh, okay.
Right? It's like a, my hand's moving crazy here, but it's like a curve, right? You're at the wrong side of the curve at all times, right? You want to avoid that at all costs.
All right. So with that, I'm going to ask Sean to send a second polling question, and then I move back to you, Jason, with you have this experience of product creation from scratch, and you've done it, and does that mean you could fall into the danger of trying to be too active with the companies you invest? At the end of the day, you're an investor, you're there to support them. But if you see them doing something you believe is a mistake, it's very tempting to say, no, 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 you should do this and that. So I wonder if that's a danger you aware of? Is that a bias that you need to be careful about, or do you think it's an advantage?
Yeah, I think it could be an advantage or a disadvantage depending on how active you become. So one of the things that we structure into our deals is not a board seat, but a board observer seat, right? So we don't really impact the startup's roadmap, but we do have a view on the startup's roadmap. So we tend to have an open door policy around things that are not affecting the product that we are developing directly, but we view the startup as our accelerant for the products that we develop inside of Volvo, right? So 100% we have, you know, a lot of impact on the products and the ventures that we see on our strategic roadmap, and the startups that we work with insert themselves or have to be a part of that roadmap. So we influence that 100%. What we don't influence is the startups additional roadmap outside of what they're doing for Volvo, right? And we don't want to do that because, again, we are focusing on companies that are at their very early stages. So we want them to use their core competence and leverage it to grow, right? I mean, we're completely aligned there because we're equity holders. So you don't want to have an active role on the startup's product roadmap, but you want to influence the startup's influence on your own product roadmap, right?
That makes sense. And maybe I have a double click here. When you say we influence, do you mean the corporate VC, VFS, or do you mean Volvo, the business groups?
Both,
Okay.
because we work very closely together, right? So again, part of our criteria is we won't invest if there is not an existing or highly potential commercial opportunity with the startup. And really what that means is our investment is tied one-to-one with the commercial relationship. So
condition for investment, you cannot invest without?
Yeah, it's not a stated condition, but it is an unstated condition.
Well, I'm guessing you just stated it.
Yes, well, yes, exactly. It's not a condition that's in our investment charter, so to speak, right?
Okay. So potentially you could make exceptions.
We could make exceptions, but it would be a difficult exception to make. And some of this, Nicolas, is just because we're at our early stage of development as a CVC. In 10 years, I mean, we might make bets that are moonshots, right? But for right now, we're really focused on driving an agenda over the next 5 to 10 years. And there's no reason for us to go outside of that agenda.
No, that makes sense. I want to talk about something which I was very impressed with, how you design your corporate VC, which is all about very, very good execution after investment.
Yes.
But in your presentation, you mentioned you're the big ID guy. And so tell me about how you balance this personal tendency to be more on the big ID, and how you make sure that the execution actually is going to be flawless or as close to flawless as possible.
Yes, that's a great question. So I have a sincere belief and bias towards CVCs that are tied directly to their corporations or their motherships strategy, and that strategy should have a 5 to 10 year outlook, right? If you're in more of the transformation bucket, then you need to look very far out. And that's where the big idea mentality comes from, is how do you envision the company in 5 to 10 years, and then how do you get there? So part of it is an internal strategic sell around, you know, where do we view ourselves in 5 to 10 years? And then that translates back into, okay, do we have the core competencies to get ourselves there? Or do we need help from some of the external partners that might be out there that have invested a lot of sweat equity in their view of the future?
So if I ask about the first company you invested in,
yeah.
I like to think about two ways when you make an investment. You look at everything that can go wrong, but you also look at how well it can do if everything goes right. So for your first investment, in 5 years, if everything goes right, what do you think they will become?
Oh, okay. So great question. So in 5 to 10 years, if everything goes right, and I'll start from the Volvo side, okay? In 5 to 10 years, if everything goes right, Volvo, particularly Volvo Financial Services, will have a fully connected insurance platform where all of our vehicles are attached and insured by us through our partner. That's why we've invested in this company, because they allow access to insurance carriers across the world, and Volvo is also across the world, right? So that's from a pure product success standpoint, right? You know, it has certain KPIs. I won't mention them on the call here because some of them are private. But suffice it to say, you know, we'd love to have all of our vehicles in the future be connected and insured by Volvo. Okay.
Very nice.
So that's the success for us. And then for the startup, because again, we have the other side, which is the equity, right? We want to see them grow through all of the rounds of startup, of the startup life cycle that you would expect, right? To an exit, right?
So, Jason, I think you're giving me a very good transition to a question that was asked by Lee Sessions.
Okay.
Here, what you're saying is a huge strategic success and financial success. Yes. And Lee is asking the question about the first question on the poll, which is, are you financial or strategic? Is it a trick question? And what he does not know is that before this broadcast, we had a chat beforehand where both Jason and me, we don't like these questions because it anchors on a false choice. Are you either strategic or financial? And with Jason, we discussed that actually the way we need to look at it is you need to look at the overlap between financial and strategic. And this overlap is where you should invest. And from TDK Ventures point of view, I can say that we believe that if you do the overlap, you're more likely to invest in the companies that could be successful, because financial returns mean also success, which means they are the companies that are likely to get the alpha customer, to pivot the first, to get the beta customers. So it's definitively a false choice that was in that question, and that's why we don't like these questions. Yes. Jason, do you want to add on top of that?
Yeah, I do. And you had the perfect answer. It is an overlap. And it goes back to what we talked about earlier around the investor's dilemma, right?
Yep.
That choice between financial and strategic and the overlap is your investment selection, right? You don't invest if there is no overlap. It can be on that overlap has a lot of a wide spectrum in between it, but it has to overlap. So, you know, I once tried to develop a model that could kind of quantify strategic versus financial fit. And what happened was every investment I put into it, the ones that were one or the other, they didn't meet our criteria. The ones that were between 40% and 60% met our criteria. So that just led me to believe that if there's no strategic fit, then I'm not going to invest. If there's no financial fit, then I'm not going to invest. So it has to be that overlap. And that can be assessed in a lot of different ways. You know, what questions do you ask? You know, how excited is the management team around the investment? Because without management buy-in, then there's no strategic fit, you know, all of those things. And that eliminates that part of your bias, right? Because you've identified that it has to meet both. Then it just becomes a timing decision, and the timing can be alleviated by the structure.
Very good. I had another question, but I see Lee's actually giving it. He says, totally correct. The magic of corporate investing is doing both. Yeah. No such thing as a strategically relevant insolvent company. And Jason, if you remember when I introduced you to Paul Holland a year ago, yeah, I think he has one very good say, which I really like, and it resonates with me. You don't want to invest in companies that you worry you will be ashamed of their logo in the future, where you look at all the companies you invested in and then you're ashamed. And in a way, the fact that I have all my portfolio companies in the back, and this video will be published, means that I have to be very confident that I'm proud of them, and I will stay proud of them. Yes. Now, I'm hoping to be correct and not to be proven incorrect.
Well, you've made great choices so far. I mean, you're one of the more recent CVCs. I think we started around the same time, and yep. You've been extremely active. So congratulations, and much continued success there.
Thank you, Jason. And I'm moving on because it's not about me, it's about you. I have a question from Masatoshi. What is the alignment between Volvo Ventures and VFS Ventures, if any?
Yes, we do have alignment in that we both are part of Volvo Group. Volvo Venture Capital, Volvo Group Venture Capital, VGVC, sits at the group level. So as I mentioned before, we have probably 9 or 10 brands that Volvo Group owns. Each brand operates as its own separate entity, but we all report in to the group, okay? Volvo Group Venture Capital tends to focus more on what I would call core vehicle technology. So they're really focused on, the things that will enhance the next generation of a commercial vehicle, right? So LiDAR, all of the things that would go into the vehicle itself, deep technology. What we're doing at Volvo Financial Services Innovation Ventures is more around fintech and service delivery, right? So again, insurance, payments, electromobility services, things that you sell to the customer after they purchase the vehicle. So that's kind of how we distinguish between the two, but we do work very closely together. And they have certain investment criteria and things that are much more moonshot focused, where ours is much more, 5 to 10 year service delivery focused.
So do you see a scenario in the future, maybe not right now, but in a few years, where you and Volvo Ventures would invest in the same startup?
I view it more as a feeder model where we can do that right now, right? We wouldn't do it at different, this is where the timing structure comes in, right? So what we're doing is much more R&D focused and future delivery focused. What they're doing, I think, is could be viewed as more growth focused, right? So either if we invest in a company and they get too big for their britches, then we would probably shift it to our Volvo Ventures partners who have a more kind of traditional CVC fund. And if they see a company that's too early stage, they probably push it to us and allow us to put it through our acceleration platform. So we work pretty closely.
Very powerful. Do you make that Volvo family value to the entrepreneurs you meet? Do you explain that as a value you can bring?
We do, and Volvo is a huge company, right? We are a global platform. So when a small startup, I like to say that we allow startups to test their product at OEM scale, right? Because what's great about Volvo Group is that whoever we work with, small partners, large partners, we automatically put them into a global environment because that's just how we operate. So we might run a pilot in, the US, but it has tremendous implications up front for other markets out in the world, right? So with that, yes, we absolutely interact and we allow the startups to have, carte blanche with the entire organization. So, but we try to guide them through because again, we could represent their biggest customer very quickly, right? But we don't want to do that. We want to make sure that the startup has, customer diversity, right? So
very nice. Yeah. I'm going to ask 500 startups. I know we've been very harsh to them about the first polling questions, but we can send the third and final polling question now. Jason, a lot of our job is to actually position our corporate VC well to the entrepreneurs so they can really understand the value we bring, what we're interested in, and everything that we will be helping them along the way.
Yes.
I'm going to test you, and I didn't prepare you for that question, so I hope it's not too tough.
Okay.
But and we ask that many times for our founders. Can you give me your 30-second pitch for VFS?
For VFS or for VFS Innovation Ventures?
Sorry, VFS Innovation Ventures. And 30-second pitch to entrepreneurs.
Yes, yes. So 30-second pitch. VFS Innovation Ventures is the best way for startups to gain access to Volvo Group and to test their product in the commercial vehicle space. We provide capital, we provide advice, and we also provide, as I mentioned before, scale that a startup probably wouldn't have without us. We're in a great position because we operate in an OEM space and we're an oligopoly. So there's only, 3 to 5 players. And after that, it falls off pretty quickly. So for a startup to get access to one of us, it means a huge amount, it's a huge win for them from not only a value perspective or valuation perspective, but also from a product development perspective.
I'm impressed. This is what I like is that you start about the value and the benefits you bring to the entrepreneur. This is actually, I'm very impressed because I totally did not prepare you for the question, and it's really a good way of starting and explaining the value. And you're right that actually it was not obvious to me that there are very few companies that can actually be in that space.
That's
helping them and to bring them scale and a place where they can grow. This is a huge deal. So I think you did well. I would give.
There's very few companies. There's very few companies, and TDK is one of them as well, right? Sony, I can think of, right? GE. There's very few companies in the world that truly have global scale, meaning they operate in over 20 to 30 countries. I mean, we're in 100 countries, right? So, and OEMs are really the only companies that are in every single country, which is why I chose this sector, right, to kind of build that integrated network.
It's very, very nice. So part of the audience is already doing corporate venturing, but probably some of the audience are thinking about starting. Yeah. Can you give 1 or 2 advice to Jason Miles, who is about to start? And what would you tell these founders of CVC to be careful about, or to really think very carefully about?
Yeah, I mean, again, it comes back to biases, right? So selection is your first major hurdle. If you're not a part of corporate VC right now, but you might be in an industry that you really like, then you've made your first major selection. It's important that you have a view on the industry that you're seeking to fund. Without that, it makes it very difficult for you to understand the timing side of the equation, right? So select your industry first. Make sure that you're really excited about it, because these are 5 to 10 year investments. So for you to see the fruits of your labor, it's going to take a while. So that would be the first one. For me, I selected Fintech and transportation because I saw that interaction as something that was going to really take place over the next 5 to 10 years. The second thing I would say would be, train yourself if you haven't gotten it from your company or your educational background. Train yourself really on the basics of investments and finance and just business in general, because working with startups requires that you bring that whole tool set to bear. I find myself speaking to startups about marketing, management, finance, capital raising, strategy, everything, right? And you have to, as an investor, be, they say you have to be, a mile wide, a mile deep and an inch wide. As an investor, you have to be like half a mile wide and half a mile deep. So you have to pretty much be able to talk about everything.
So I think this is a nice plug for 500 startups with a VC Unlock program. Do you want to share for 2 minutes what you learned, what you liked, and how it helped you to do well afterwards?
Yeah. Actually, the VC Unlock program, it's a good plug. It's one of the best courses that I've taken that has been purely focused on venture capital. You know, again, for me, I had a finance undergrad. I have a finance MBA, and I've operated within VC in and around it. But the VC Unlock program really brought everything together in a very short time frame and gave some great frameworks to use, which were very practical. And I think that's the part that you can't really learn. Someone has to give it to you, or you have to be in a VC. So it really was an unlocking of all of the value of kind of the VC market. So I liked it a lot.
And you forgot, but we got a lot of good friendship from it.
Of course. That's where you and I met, Nicolas, right? So yeah, it was great. It was great.
It was great. And we met again in Brazil, a dozen of us, and we met with VCs in Brazil, and we learned even more. No, it's a good plug for 500 startups, because indeed there is a lot of things that we don't know.
Yes.
And what I think is very important to say is that corporate VCs have had a bad rep in the past. Yeah. And if you make mistakes, you're not going to have a second chance. And so starting right and starting with the right mindset, and that's why I like your 30-second pitch, because you start straight to the benefit for the entrepreneurs. And all of this really needs to be built into the execution as well. But it's what you don't know is a mistake that actually is going to be the problem. Right. So on that topic, you haven't really said a mistake you made you wish you didn't. So
we're very early, so it's
I know. But is there something that you feel you could have made a mistake, but because of the network, VC Unlock, and maybe other people that have given you advice, you realize would have been a mistake and was good to avoid?
Yeah, I think here's one that I think we've successfully avoided, but it's been difficult to avoid. I'll say it that way, because we haven't made the mistake, but we're always in danger of making the mistake, okay? And it comes back to your biases, right? Once you have a great thesis and a great selection criteria, you have to be very strong and disciplined about not veering from your criteria. If you've developed your thesis correctly, then you shouldn't have to veer away from it. When you start veering too far away from it, that's when you introduce additional factors that you might not have known of before, right? So, for example, one of my major hurdles for making an investment in a startup is, because I'm a strategic partner and I'm a CVC, is do they have a financial partner at the table that has nothing but financial motivation, right? So do they have a traditional VC on their board or in their cap table? Or do they have an angel that has a banking background? Someone with pure financial motives makes the startup much more disciplined about the decisions that they make. And that's one thing, that an area where you could potentially, as a CVC, say, well, they don't have any financial investors, but they do meet our financial and strategic fit, so we should just make the investment. But by doing that, you introduce additional biases that you might not otherwise see, because they don't have the financial discipline, of having just a cutthroat, quote unquote, financial guy at the table. So that's where I can see the bias creeping in. And I myself have had to fight that, not only with myself, but also with my colleagues about, well, this is a great company. They do everything right. They might be a good partner for us. And I have to say, yes, but they don't have a financial investor.
I think you're making a very good point, because I've seen the spectrum of CEOs who only want to do financial VCs and they don't want to do CVCs anymore, or not, all the way to the one that only wants to do CVCs. And I'm very worried about the one that only wants to do CVCs.
Yes.
And I think you're right. You need someone who is looking at it from a financial point of view and who does that as a job. So I think a good mix means for me a CEO that's very mature, very smart, because he's looking at it from, I need the financial VCs, but I also want the value of the corporate VCs.
That's right.
If you don't mind bringing back the last slide of Jason, there was a number of bias mentioned. Yeah. And I would like, Jason, if you can talk a little bit about these biases and what do you think is a key message you want the audience to leave with? Because I think everything we do is about decision-making and investment and so on. Yeah. But is there a message on bias that you really want people to leave this webinar today and think about, really, really deeply think about?
Yeah, I do. And that's a great segue. And again, thank you all for having me here. This has been really, really enjoyable. You know, the three biases that I really think about pretty often, and I think every investor should think about, we've talked a lot about investment selection. You know, you have to choose right. And that comes from making a great thesis up front and having your criteria very clearly defined. The second bias is around FOMO, or fear of missing out. And that has to do with kind of the timing, right? The third bias, which is kind of has been the elephant in the room just in terms of our industry, whether it's corporate VC or general venture capital, is diversity, right? And, you know, I tie that back to the first two in a number of ways. So from an investor standpoint, you know, I think we're starting to realize that innovation is what I like to call locally owned, but globally executed. You know, it can come from just about anywhere, right? We live in a much more connected world. And because of that, you know, where in the past folks thought of investment, especially early stage investment, from a risk mitigation standpoint, now I think people are starting to think about it from a return perspective, right? And, you know, diversity of thought, diversity of culture, diversity of gender and culture and ethnicity, beyond just the, you know, the moral and the social benefits, I think bring benefits and investment return, right? You know, taking risk in terms of the thoughts that are around the table and the people that are around the table, I think really enhance the ability of a CVC or a VC to make great investments. You know, and it really allows you to look at the idea and not at the messenger, or the message and not the messenger, right? And that message may come in a variety of formats depending on what part of the world you're in and what area you're focusing on. So, you know, when I think of the investor's dilemma and the biases, it spans the entire spectrum from the investments you make, the types of folks that you back, and the ideas that you have. So, you know, that would be my key takeaway is, you know, think holistically around everything that you do, because you never know when the next piece of information is going to come in.
It's great, Jason. And I think I will stop here because I want to finish with something so meaningful. And thank you, Jason. It was really great to have you today. And you were in a very good sharing mode. And I think it's going to be useful for so many people who are thinking about going into corporate venturing or getting started already. So thank you, Jason. It was really good.
Yeah. Thank you, everyone.